Welcome to the Real Retirees of New Jersey, powered by Liberty Financial Group and Artemis Wealth Advisors.
It's important to inspect what you expect. If you're not inspecting your plan, if you're not reviewing your plan,
or if your financial advisor is not inspecting it,
correct,
then you need a second opinion. Come see us.
Randy and Peggy Fisher want to help you retire once and retire right.
And it's all powered by Artemis Wealth Advisors and Liberty Financial Group. Welcome out to the Real Retirees of New Jersey. Thanks for streaming the show. All the information, you can find it here in the show notes. My name is Mark Owens. All right, listen. We're going to continue our conversation about the biggest myths and misconceptions in retirement. Last week, we got to a total of 1. My goal today.
We did good. We did good.
Great information.
Really good.
Great information about, no joke, about Social Security and how is it going away? Will you have your benefits when you retire? What path should you take? We invite you to go check it out. Now, my goal for this week is to get to 2.
Number 3?
No, listen, whoa, hold on. Let's just try and get to 2 first. But I do want to start with this one. A big myth or misconception in retirement. Peggy, retirement planning is just about investments. How is that a misconception?
Well, I think if you do go to like some of those large firms, it can be just about financial money advising only. We like to say here at Liberty Financial Group and Artemis Wealth Advisors that we're not just about just wealth management. We're about all of it, all encompassing. You're going to a car dealership and you're like, should I lease or should I buy? Let me go call Randy and Peggy.
Right.
You're going to do some health care.
What does that mean, all encompassing?
All encompassing, meaning we're not just about wealth management. We're about wealth management, insurance, car insurance, life insurance, homeowners insurance. Like I said, should I go rent a car, buy a car, lease a car? Should I, with my health insurance, do you think I should pay this amount? Should I not take this section? Should I use this section? I mean, we're about everything. When someone comes in here, we always say we like to treat you like family. Mm-hmm. And that means we talk about everything. And we don't charge for that.
Right.
We like to help people with everything that they have, including financial wealth management and anything else that they would need.
Then where do we get to that point? But where do we get to the point, Peggy, where people think that it is only about investments?
So how we get there is we just had a client come in recently. He was from a big box firm, said he could, every time he tries to call somebody, he talks to somebody different, right? Yep. As opposed to like always knowing, hey, I'm talking to like a Randy or a Peggy. I know when I call. First thing I said to him is, listen, you have our cell phone from day one. You don't have the 800-866, whatever. And another thing I said is, can you call them on the weekends and say, hey, oh my God, I just had a terrible event. I need to get some money. No, somebody's not going to answer your phone on a Sunday at 2 o'clock in the afternoon. Here we will. I'll tell you that right now. We've done that for many clients, right, Rand?
Mm-hmm. Yep.
Oh, yeah.
Even on vacation.
Correct.
Standing on the beach.
Standing on the beach.
You've said that before. You've actually had conversations in the hot tub on vacation with strangers about retirement strategies.
Always.
Not strangers.
Always.
Customers.
Yes.
Clients. Family.
Or they become our clients. We were just recently away, and we had some people become clients who were, there who said, oh, God, you guys are financial advisors. Great.
They were in a hot tub.
Yeah. And then in the beach. It was good.
I can't wait for your next client event. A hot tub party.
The hot tub time machine.
Hot tub time machine with Artemis Wealth Advisors. So you tell me that, too. I want your thoughts on that. When people think, Randy, that retirement planning just only about investments. Like, how is that such a myth in your world?
That is a myth because retirement planning, most people think of retirement planning just as money, right? What's my 401k? What's my IRA worth? What's my dollar value of my portfolio? And the sheer fact is, I've never seen money retire people. People retire because they need income, right? Another Randyism, as you said, is income is the outcome that matters most. It's a sheer fact. If you don't have income or you have enough money coming in and less money going out, you particularly can retire.
Right.
Right? I can have the biggest accounts in the world. If I can't get income from them or create a lifetime worth of income or a consistent amount of income, I can't retire, right? So that's one of the biggest fallacies there is retirement planning is only about money.
Right.
Retirement planning is actually about income. In addition to income, it's about health insurance. It's about legacy planning. It's about estate planning. It's about taxes, right? So, I always hear this is big box firms and many of the advisors that are out there, they do not give tax advice because they're not tax advisors.
How do you not give tax advice when you're getting ready to retire?
It's literally impossible.
It is.
Now, we do give tax advice, thankfully. We do prepare taxes, and we've got a network of individuals that actually help us with that as well. But the sheer fact is this. If I have a retirement account and I take money out of the retirement account, does it affect my taxes?
Yeah, sure does.
What else could it affect? It could affect other forms of income. It could affect, we mentioned this in another podcast, it could affect IRMA, which is basically a penalty to Medicare insurance.
How about we just had a client.
How about other qualifications for anything else we're qualifying for?
How about we just had a client who came in the other day, right, Rand? She said, I want to pay off my house.
Yeah.
Right? And we said, oh,
and she's not the only one. There's many people that have done this.
I said, where are you going to take that money from? What'd she say, Randy?
Her IRA.
Her IRA. Randy goes, do you understand if you take it out of your IRA, all that money is taxable. So you're not just paying off your house. You're
Uncle
also
Sam.
paying Uncle Sam.
Yeah.
So the money, she was going to have to pay, just off the cuff, $35,000 if she thought she wanted to do that. Because she had no tax advice. And she's like, thank God I came to talk to the two of you because I was about to do this.
Right.
I mean, that's just a simple little thing.
And there's many other people that do things like that too. They
Crazy
say, I need to buy a car. I need to, I want to paint my house. I want to upgrade my furniture, whatever it may be.
Yeah.
We call it the hierarchy of money, right? So if we look at the amount of assets in which you have or which type of assets you have, they're going to be treated differently. If I withdraw money from a non-IRA account, is there gain or loss associated with that?
Right.
And what we do there is something called taxed harvesting. Taxed harvesting basically matches up gains and losses and combines them together, which essentially negates the taxes that are due to Uncle Sam. In plain English, if I had an amount of money or units that had $10,000 worth of short-term gains, and I had other units that actually had short-term losses for the same amount, if I sold the equal amount out, and I had $10,000 worth of loss and $10,000 worth of gain, I can free up both of those positions, use all or any of the cash, and 100% of it was tax-free.
Right.
That's tax planning, right? Now, there's many people that say, oh, my advisor, they tax harvest in December. Well, what happens January, February, March, April, May, June,
What
July,
are you
and
doing for the
August,
rest of the
September,
months?
and October,
Right,
November?
exactly.
Yeah.
Right. So do you think you have any tax consequences between that period of time either, or
course you do.
any opportunity?
Yeah.
Absolutely. Why wait to the last month or last week of the year in order to play around with some tax, strategy that should be deployed throughout the entire period? So we do that as well. Secondly is, let's say someone comes to me or anyone else and says, I have a non-IRA account, but I have stock in there and I bought it 10 years ago and I want to sell it. Okay, well, what are the consequences? Now, there are long-term gains, but how do they affect my taxation?
Right.
Are there ways to reduce that? Yes, there are. And there are different strategies that are out there. What does a large box firm say? It's not my responsibility because we don't give what?
Tax advice.
Tax advice.
That's it.
Right? Hey, we got you to the dance, but we ain't dancing with you.
Yeah, right.
Yeah.
So it's the same concept. So I don't think it's a full holistic approach
Right.
to the entire strategy. What are the tools that you can use that may combine multiple benefits? What do I mean by that? Well, if I have the need for legacy, but I also have the need for long-term care options, could I use a specific tool that can give me both?
Absolutely.
Absolutely. You got to use the right tool for the job, right?
But a lot of people don't know what those tools are. They only think there's one tool or two tools to do that with, right?
And again, nor are they getting it from a traditional brokerage firm.
Exactly.
Because you need specific type of licenses or qualifications in order to sell those type of products.
That is correct.
Which leads us down the road of income. Income is the outcome that matters most in retirement. You have red sources and you have green sources. Green sources are 100% guaranteed income. Red sources are living on commission. Red sources are my brokerage account with an IRA. When the market goes up, I can take money out of it. It's not going to affect it. When the market goes down and I take money out of it, that's not good, right? Because I have to actually make money up. That's living on commission. Then I have to make a choice. Well, the market's down. Should I take money out or should I not take money out? If I'm in a guaranteed source of income, no matter which way the economy is going, no matter which way the market is running, I know if I look in my checking account or I go down to the mailbox, the check is going to be there. Right? That's income planning.
Yeah. Not only that too, but I also think it's psychology. Like a lot of times we talk to people about things. Are they going to be able to talk to a big box firm and say, oh my God, I'm like going crazy right now. I'm about to do something money wise that's just not, I don't know if it's good or bad. Are they going to sit down and talk with you? No. Absolutely not. Will a financial advisor at a smaller firm do that? Yeah, absolutely. If you're doing your job correctly.
and again, compiling Social Security planning into that mode. Because think about it, Social Security is the number one form of income that people have when they retire right now. We talked about that in another podcast. It used to be pensions. Only 14% of corporations out there still have a bona fide guaranteed pension plan, which that's great if you do have it, but most people don't. So then that's gone. Most people then start with Social Security, make mistakes, and then it's supplemented by any of their other forms of retirement savings, which is 401ks, retirement accounts, non-IRA accounts, yada, yada, yada. So how do all those things fit collectively together? That's retirement planning.
Fascinating. All right. So as we're talking about Social Security, as we're talking about how retirement planning is more than just about investments, you kept mentioning a word there. It's an evil 5-letter word, and we're talking about taxes. Another misconception that a lot of adults have is, Peggy, Randy, once I retire, my taxes will automatically go down.
That's not true.
Big old myth.
Right.
Tell me why people think that or feel that way.
It's a myth because the sheer fact is when most people are working during the course of their earning years, they have the way. Let me back up. The way taxes are filed, you can file them through a standard deduction or you can file them through individual itemized deductions. Itemized deductions, what are those, ladies and gentlemen? Those are basically your property taxes, state income taxes, donations to charities. You get the picture. So if all of those add up to a certain amount of money, you can deduct those items, particularly, and again, I'm not going to get into the weeds, but you can deduct those off of your taxable income. If you don't have those, and many times later in life, people are actually have their mortgage paid off, so you no longer have
the
interest deduction, right?
Yep.
Or they're more tightly wound to their budget, and they're actually giving less in charity, or they have many, many, many less itemized deductions, they take advantage of the standard deduction.
Right.
Unfortunately, when that happens, by taking the standard deduction, they don't have more to write off. Less to write off, more taxable income, right? What else do you not write off there? Well, you're not reducing your salary or your income by your contributions to your 401k plans. That's a big deduction for a lot of people.
It sure is.
Right? I mean, sometimes that reduces people's income by $25,000, $26,000 a year.
Right, big time.
When you're on Social Security, that is pure income. There's nothing you can write off against it, right? If you have a pension, there's nothing you can write off against it to reduce that down. It's not like a business income or anything like that. So your taxes are in an entirely different category. That's why most people think that in the future, they're going to earn less and be taxed less. They're really not. So, and to think about this, most people that are earning, let's say, 150, 200, 250 in income, when they retire, they're not retiring at that level, but they're retiring at maybe $100 and some odd thousand. $100 and some odd $1,000 for a couple with no real deductions, you're getting whacked with taxes.
Yeah, big
because
time.
You're in a different realm, right? So it's a fallacy that people will be entirely in a
zero tax.
Let me say it this way.
Yeah.
They'll pay less in taxes. That's a fallacy.
And as it comes to tax strategies, you often hear, especially right around April, you see a lot of the commercials of people saying, hey, if you call me, I can give you a tax-free retirement. Hey, you click this link and you'll pay 0% taxes in retirement. Is that even possible, or is that a big myth?
Well, it's interesting. I think it's a play on words.
Yeah.
Because there are strategies in which you can employ to receive tax-free income, right? So you can use Roth IRAs. You can convert IRAs to Roth IRAs. You can use Roth 401ks. So Roth is a code of the IRS code, which essentially says money's growing tax deferred, it grows tax free, and eventually, it grows tax deferred. Eventually, I can take it out tax free. Are there other instruments in which you can do that with? Well, kinda. So I know a lot of people like to describe a life insurance concept, which basically what they're doing there, many people call it a LIRP, which is a life insurance retirement plan. Fortunately for people who actually work with advisors that know how to do it, it can work well, but you have to be very disciplined and it needs to be constructed properly. If it's not constructed properly, it is a nightmare.
We've had clients
and unfortunately
who've been in nightmares.
Most of the people we come across with that say, I have a LIRP or I went to some dinner workshop and I did this, can you take a look at it? It is a lawsuit and a nightmare waiting to happen. So it's not it's supposed to function properly in theory, but if it's not done properly,
right.
it is a nightmare.
Right.
Nightmare.
And what do you find that as we've passed by tax season, and I know you're not CPAs, but you do work on, because there is a difference. I have learned this from the Real Retirees of New Jersey, the difference between tax planning and tax prep. Tax preparation is looking back and filing for the previous year. Tax planning is looking forward for your taxes on the upcoming year. I learned that.
Somebody's listening.
I see. I wrote it down. I have a Post-it note right here. But what do you find that most people, now that tax season, quote unquote, is behind us, what do you find that most people get wrong? What are people, not understanding about their own tax situation?
Well, just about getting prepared for the next year until they then call in December and go, oh my God, now we have a crisis. It's about pre-planning for that. Like, just because, April 15th is come and gone, doesn't mean that we just then forget again until December. I think that's the biggest thing that happens with our clients. Absolutely.
It's a difference between proactive and reactive.
Yes.
Yeah.
Right? So, you mentioned it, Mark. Preparing your taxes is a historical event. That is it's like post-mortem, right? You can't do anything to fix your health once you die. Once, December 31st comes, you really can't do much to affect the taxation of what you're actually going to do to have to file, right? There are numerous tax strategies in which you can take part of throughout the entire year. And I think Peggy hit it on the head. Most people put tax season behind us. And when they look forward, they're like, well, thank God, I don't have to look forward to that for another 8 months.
Exactly.
Right? So
that's a lot of people.
That's the problem. If you were preparing taxes and you were busting your behind for the past 4.5 months, take a couple of days off. But if you were the person who needed to get your taxes prepared and you were paying Uncle Sam, you need to do some tax planning. And Peggy mentions this a whole bunch of times, and I laugh at it all the time. People come in and they're like, oh my gosh, this tax season was amazing. I got a refund of $26,000.
You know what that means? You paid way too much.
Yep.
Yeah, I mean, it's stupid.
Yeah, it's crazy.
They're like, oh, no, that's our forced savings plan. Oh, what'd you do with it? We went on vacation. Oh, okay. So let me get this right. The government took $26,000 extra dollars out of your paychecks throughout the entire year.
That you could have been using the whole year.
They gave you no interest, and then you decided to spend it.
Right.
That sounds great. You know what we should do tomorrow? I think we should run in traffic.
If it makes you feel better, in the Owens household this year, we got a little bit of a refund. Just a tiny.
That's okay.
I'm pretty happy with it, because you often hear that cliche. You have exactly that. Like, oh, if you get money back, you paid too much. But I mean, there is that fine line. Not having to write a check too big, but not getting a check back that's too big.
Yes, that's exactly what it is.
Yeah,
exactly.
that's 100%.
Yes.
As close as you can get to zero on both sides of that line.
That's what we always say.
That's the smart move.
Absolutely.
And we got a little bit back. I was pretty proud, and I was like, yeah, well, we did much better this year. And I'm sitting there thinking, well, let's do that. Why don't we go on a little trip or take a little family vacation or go? And then I am the chief entertainment officer of the family, and then the CFO, my bride Gretchen, comes in and says, you stupid idiot. No, we're taking this money we got back and we're putting it into savings. We're putting it into a retirement account. We're going to pay off some of our bills. Stop trying to have fun with it's our money. Stop trying to have fun with money that we've already paid taxes on.
She's a fun killer.
I have
one of those.
What's her name?
I have a fun killer.
Yeah?
It's Peggy.
Where can I find her? Right beside you.
Just look straight ahead.
Right beside you. She's got a big smile on her face right now. All right, good conversation. Hey, look, I think it's a good place to hit pause for this week. Look, we got to 2. I'm so proud of you guys.
Did good.
I told you we weren't getting fast at.
We're going to get to all of these by 2029. I can't wait.
No,
2029. We can
2029.
We could definitely do that.
Well, that'll be when that grocery store in New York City is up and running.
We'll have a live broadcast from there. Hey, you want more information? Find it at therealretireesofnewjersey.com. Randy Fisher, Peggy Fisher, Artemis Wealth Advisors, Liberty Financial Group, as always. Thank you for the education. Thank you for the information. And thank you for streaming. This has been The Real Retirees of New Jersey with Peggy and Randy Fisher.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Investment advisor services offered through Artemis Wealth Advisors, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Artemis Wealth Advisors is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Randolph A. Fisher, insurance license number 9616074, and Liberty Financial Group, LLC, and Peggy Fisher, national license number 189-42003 and 570-5833.